Got it.
So you have to set it so that when you share your screen, there's no gray box. So if you go down to the little icon where it says start video, click on that bubble. Then you want to click on video settings. By the way, you can pause this video and hit watch this video settings. Then click on video settings. And up here we see share screen.
Oh, then need to mute also. Oh. Yeah, I'll admit them already.
You can try this to get rid of the screen, the patches. You go to this share screen setting there. You know the video, the icon below? Stop video down. The side.
Okay, never mind. I don't think I have time to do that for now lah.
Okay.
But thanks anyway. Hi, Christina.
Hi.
Hi, Ping Hui. Thanks for coming. Sorry, is it Ping Hui? Okay, so we just wait for a while more. Okay, so since since we are at about 8:01 now, I think we'll just start. And thank you so much for those who have come on time, Christina and Ping Hui. So today we will share about the evergreen strategies through periods of volatility, especially with regards to large amounts of wealth. So yeah, I appreciate and thank those who have come on time. Yeah, so I'll just continue the session from here. Okay. Why can't I go to the next slide? Okay, so does it feel like the whole world is turning upside down and tossing all over the place? We are at a point where there's war in Ukraine, we have war in Ukraine and Russia, and then we have also the war in Israel that's happening right now, correct? And also we feel that interest rates are going up, inflation and cost of living has been going up to sky high levels that we have not seen before. So suddenly the world is looking like over here is just at the edge of the mountain where it can actually fall off anytime. So that's how we are feeling right now. And one of the things that I also want to share with you is that during this session is not to focus, not to confuse between the difference between effort and results. So, sometimes you can put in a lot of effort, but we don't yield much results. Or we may be thinking that we get some results, but then we are putting so much effort that it may not even make sense. Just like over here, this slide tells you, if you're too busy to enjoy quality time with your family, it's time to reevaluate your priorities. So recently, I was talking to a friend of mine. He told me, Greg, actually, I've been doing very well in my stock portfolio, and he's been managing it on his own. And I asked him, how do you do it? How do you do so well? He said, wow, actually, I spent a lot of time going through research, reading all the annual reports, the financial statements, and so on and so forth. And he says, well, every year I probably set aside about one day just to do that, one full day to do that. So on a yearly basis, it's actually about 12 days a year just to do that. And I asked him, hey, by the way, how much is your portfolio? How big the size is it? His portfolio size is probably around 100 over $1,000. And I asked him, why 100 over 1,000? I mean, you've got a larger chunk of money there, right? Yeah, he tells me, of course, I'm worried, right? You know, what if suddenly I put in 500,000 there and then the money disappears? Because that's the scary part when we don't asset allocate. So you want to be able to enjoy that family time. So that's important as well. So you can see over here, you are right in the middle and you have got all the different parts of the planning over here. Today we'll just focus only on the investment planning part. But there are other areas such as the income and asset protection, the debt and lifestyle, the wealth transfer, the business and tax planning. So for those people who are business owners, we actually do a lot of business planning for these people as well. But today is only on investment planning. So one of the things I want to do is to help you to shift your paradigm to life and in investing. I think most of us have seen this picture before, right? Looking at a certain angle, you might be able to see an old lady. And if you look at a certain angle the other side, you will see that actually there's a very young, pretty lady with very nice eyelids. So if we just focus on this, we realize that actually there are two ways to look at the same picture, but we come up with different objectives at the end of the day. We come up with different outcomes. So I want you to keep an open mind for the next 1 hour, because if you want small changes in your life, you have to work on your attitude. But if you want big and primary changes, you have to not consider what's happening outside, but you work on your shifting within yourself of that paradigm. That's what Stephen Covey says. So what do we really want in our lives? If you really think about it, the key thing is most people come to us because they want the highest returns in the stock market for the last 1 year. And they always ask us, where shall we allocate? Where shall we put into? What stock can we buy? But at the end of the day, I don't think we want the highest returns. What we want is actually peace of mind. Am I right to say that? And if you want peace of mind, the only way to do that is to be able to say, well, I can put away all kinds of thoughts and I want to be able to sleep well at night and have reduced anxiety. So we as financial advisors, we want to be able to provide you the part on the right side, that peace of mind to let you sleep well. You know, when I first started, right, I secretly wanted to be Warren Buffett. So if you can indulge me and you can do me a favor and also please participate, can you please answer this question over here? I'm going to ask you this question. Hang on. So the first question is, how many percent of investors think that they can stock pick? Can anybody just type into the chat group? It could be 10%. You think 10% of investors can stock pick and do that very well? Maybe it's 90%, maybe it's 100%. But can you tell me? So I'm looking at the chat as well to see if you can do me a favor to just reply. How many percent of investors think they can stock pick? %5%. Okay, that's interesting. Yeah, thank you so much, Kwan Siu, for your response. 5%, that's what Kwan Siu is actually saying. And then, oh, there's one more, Chen. Mr. Chen says that it's 75% of investors think that they can stock pick. Okay, thank you very much for your responses. How many percent of investors think they can time the markets? They know exactly when to get out before the crisis comes. And they know exactly when is the bottom of the market. And that's where they exit the market. So that's where they enter the market. So how many percent of investors you think can do that? If based on the previous question, I think the answer will probably be almost about the same. Am I right? And what if I ask the next question? How many people are able to do that over a long period of time? I think with that question, I think the response is probably going to be a very, very small percentage. It's probably less than even, not even 5%. It's probably a very, very small number. Warren Buffett is that 1 in 1,000, thousands and, oh, sorry, millions of people that can be able to do that. So let's reframe. Who over here likes to buy high risk portfolios and low returns? High risk and low returns. If you do, then you should buy single stocks. If you like high risk, low returns. Okay, why do I say that? They actually did a study all the way from 1976, right? They tracked the US markets. So you can see over here, there's the US markets. They showed that basically there were about 2,400 companies when they started in 1976. And of these 2,400, actually, you can see from the graph that only 175 of them, which is the blue color box, the blue boxes represent the individual companies. So only 175 of them continue to survive after the entire period till 2021. So the first thing is, actually, most stocks don't make it such a long period of time. That's the first thing we actually pick up and learn, right? But for those companies that actually make it, and for those companies that manage to continue to survive till today, we plot them on the graph over here. And when we plot them on the graph, what we realize is this, is that actually a lot of the stocks, what you're doing is you're actually having very high risk. The horizontal line basically shows you in terms of risk. So the further right it goes, it means that the risk you are taking is higher. The further left of the box that you go to, it means that the risk is actually lower. So if you are doing the single stocks, I draw a line down. Everything on the right side is the blue color, which we want to avoid and ignore. What we like is those on the left side, where we are able to have lesser risk and yet very reasonable returns. That is why we say we prefer not to do single stocks. But that was how I started, and I'll share with you my experiences. So then I think over time, what I did is I said, okay, stocks, sometimes you make it, sometimes you don't make it. Why don't we move to active funds, right? So we say, okay, let's look at the details of the funds that are actively managed. And these are big company names. So you'll hear them like BlackRock, PIMCO, Schroders, Aberdeen. So these are very, very big companies, right? There were 2,800 to begin with in year 2002. And how many percent of them survive? You look at the data over here. 40% of them survive. That means they are still around. But being around is just saying I managed to survive. But then how many of these companies actually are winners? Winners means to say that they actually do better than the stock market, the main index, compared to the main index. Only 18% in equity and 15% in fixed income are able to do better than the index over such a long period of time. So what does the data tell us? That actually is quite sobering, right? I mean, why would you want to do that? And then we say, okay, maybe there's hope, right? Let's focus on these winners, this 18%. And if they are so good over the last 5 years, then naturally we'll think that for them to be able to do well, they probably will continue to be good over the next 5 years. And let's look at what is the percentage that are able to continuously do that. Let's focus on this 18%. So they look at this and they say, okay, those that did well the past 5 years, how many of them continue to do well again the next 5 years? So after they looked at the data, they realized that only 20 to 30% of those that did very well, that were the winners, actually continued to stay on top, at the top of their game. Which means to say, if you look at the whole universe of funds, right, actually out of 2,800 of them, actually only 4%, 3 to 4% of them actually do well consistently over a long period of time. But the question is, was it more due to skill or was it more due to luck? That's the question that's at the back of everybody's mind. And I think you should actually question that as well. So that's why we stopped chasing the winners. We say there must be a better strategy out there. And what happens when you time the market? So some people say, well, let's go and buy the index, and just focus on buying the index and that's it. So But the problem is when you buy an index, there's a tendency to also time the market, right? So this is what happens. Show you this video. So you saw that video, right? It shows you that, well, if a person has stayed through investing in the index, they will have gotten to 20 over $1,000. But if you had missed the first one, the best day recovery, or the best 25 days recovery, you will realize that actually you will have significantly reduced your portfolio just by deciding to move something along the way. And the funny thing is this, the recovery that's the highest usually comes during the periods when it's the most volatile. So the Dalbar survey tells us this, the investment returns gives us X amount, whatever the X will be, right? But the investor returns, that means what the investor actually gets into, is actually way less than half of what the investment markets actually return to them. And why? It's usually because of this thing called behavior. All kinds of behavior happens along the way. There's greed, there's fear, and all these things that's coming up to us due to the use of our amygdala. So the question is this, how do we then do better than the main index without the need to stop, pick, or time the market? This is a question I will keep asking and asking and asking again and again and again, because I always want to find a way that's sustainable and reliable and able to do this over a long period of time. So the first question you want to ask yourself is, how do you make your decisions? Is it by emotions? Like this lady over here, you feel, wow, it's fearful, it's scary, or there's greed and so on? Or do you make your decisions based on data? When we make our decisions based on data, we are using this thing called the evidence-based approach to investing. So what does the evidence tell us? What does the information of the data tell us? The only way we can do that is we go back as far as possible. Some of you are actually doctors here. I saw that came in. We all like data, and we all like to crunch the numbers and see what does that inform us with. So based on the data, we will also then use this data to say, what can we apply in terms of investing as well from there? So it must be sensible, it must be pervasive, it must be persistent and cost effective. So the first thing is this, we look at it and say, well, if we buy stocks and bonds, between stocks and bonds, we always know that over a long period of time, stocks will do better than bonds. This is a no-brainer. We all know this, correct? The next thing is this, between small companies and large companies, which company will be able to give you a higher outperformance down the road? So I give you an example. By the way, small companies does not mean your small companies that are like your Zi Cha store. Small means that, let's say, for example, your large companies, McDonald's. McDonald's is a very large company, right? And then you have a small company like, say, Shake Shack. So if you think about it in terms of size, actually, McDonald's is a lot larger than Shake Shack. But actually, Shake Shack is not a small company to the point that it cannot survive next month as well, right? So it's just that in terms of relative size, it's slightly smaller. And if you keep doing this to buy smaller companies versus larger companies, you have higher outperformance for smaller companies. Next, we also look at value versus growth companies. Value means to say we want to buy companies close to price to book ratio or low PE ratio, right? Whereas growth companies are companies that are very, very expensive. They are excessively expensive to the point that price to book, you're probably paying something like 30 to 40 times or even 50 times. I mean, those are what we call sexy companies, but the reality is we don't know and we don't think that those prices will continue the way it does. Even if it does, the likelihood of a downside trend versus an upside trend is going to be higher. Then the next one is no-brainer, high profit versus low profit. If you buy companies that are higher profit, then you know you get higher outperformance, right? So this is the factors that seems to kind of make sense. Now that it makes sense, let's look at how it actually applies to real life and to what extent it goes to, right? So we look at this. So you look at on the left-hand side is the US stocks. So in terms of company size, price, and profitability, you will see that we have an outperformance for roughly between 2 to 3+% per annum, all the way from 1928 to 2019. It's almost 100 years data, right? So that tells us that actually, if you buy companies that are smaller, you get higher outperformance. More value, cheaper in nature, like Warren Buffett style of investing, you get higher outperformance. Higher profit rather than low profit, you also get higher outperformance. Now, the question is, that was in the US, right? How about the rest of the markets that are developed but exclude the US stocks? So we looked at the data again, and you get somewhere in the region of between 3 to 4.9%, which is fairly good. And we say, okay, what about the emerging markets, the Asian markets, the China, the India, and so on, right? And we look at those companies and we say, hey, it also gives you the extra 1 to 5% from there. So it tells us that this is applicable and it makes sense. But does that mean that the premiums appear all the time? Does that mean that stocks will always do better than bonds every single year? No, right? It will not, right? Yeah, but you can see the blue bar that shows you most of the time the stocks will tend to do better than bonds. But there can be periods of time, 1 year, 2 years, sometimes even a multitude of years, that they may not outperform. And sometimes bonds do better than stocks, just like in certain. Sorry, I think the internet connection got cut off suddenly. Okay, so sorry, so sorry. Can you all see? Hang on, stop share first. Sorry, just now there was an internet connection problem, so I just am trying to put it back on again. Okay, so yeah, so sorry about the internet connection. So does this mean that the premiums will appear all the time? You can see, right? It does not appear all the time. Small caps do better than large caps most of the time, but not all the time. Value versus growth, same thing. High profit versus low profit, the same thing. So this tells us clearly that actually these are the factors that gives us higher outperformance, right? So the next thing we look at is how, to what extent does that outperformance actually show? So let's take real life examples. If let's say your great grandparents or grandparents had actually back in the year 2000, let's say they had $1,000 and they had put that $1,000 into the T-bills, short-term government bonds, what would that value have grown into? So the $1,000, you can see the chart over here, would have grown to roughly about $22,000 throughout the entire period. So that's what you actually see in higher performance. But we also know that there's this thing called inflation, right? So cost of living is also about the same. In fact, cost of living is actually slightly higher than what you see in terms of T-bills and short-term government bonds. Then what if the person decides to put in US long-term government bonds? Just now, same time frame, same time frame. Just now was 22,000, right? Over here, it would be, if you put into US long-term government bonds and did not touch it at all, it would have grown from $1,000 to become $194,000. So that's quite a big difference over an entire period. But that's just bonds. Remember just now we saw one of the factors is if you put into stocks versus bonds. Let's look at what happens when you put it into the major stock market. And if you want to go as far back as possible, we use S&P 500. So same time frame. it would have gone from $1,000 to over here is $10.9 million. $10.9 million. That's the kind of growth you have seen for the stock market throughout the entire period, 1926 to 2020. That's a long period of time, but it's a significant amount of growth as well. And what you see is that it is on a trend line. It is not a straight line, but it is a trend line moving upwards. And what if we tilt to the factors that I mentioned just now? Remember just now I mentioned the factors, right? What if we tilt to buy smaller cap companies? And if we do that, we would have 1,000 to become $36 million. 36 million. So just now we heard, right? It was 22,000 for bonds, right? Short-term bonds. Now this is 36 million for small cap companies. And what if we include value as well? So not just small cap, but we include value companies, which means to say we buy companies that are cheaper in nature. What you have is that you have that same $1,000 grow all the way to $92.6 million. That's an exceptional growth, right? So although we see it as an extra maybe 1%, 2%, 1%, 2% per annum and so on, but over that long period of time, you see that tremendous growth. But you also see that it is not a smooth ride. It's choppy, right? It goes up and it goes down. So what we want to do is we say, well, we would like to tilt onto those areas of higher expected returns, but we know times can be very choppy. So we will want to tilt it to say we want to buy into areas that gives us that higher outperformance and overweight there, and we underweight those that don't give us higher returns. Meaning to say, we will probably buy more small companies, and we will still buy the large companies, but we will buy less of the large companies. We'll buy more of the small companies. We'll buy more of the value companies rather than the expensive companies. We will also buy more of the higher profit than low profit. But we want to diversify the entire world across. And remember, I said this question will always come back to this. How do you then build a global portfolio without the need to stock pick or time the market and yet get higher expected returns over time? So this is the part that will be very interesting. So we will then create a portfolio based on the person's goals themselves, because different people have different goals, right? Even between a husband and wife, sometimes we have different goals as well. So we always say, what is the goal of the person? From the goals, then we work backwards, because how we plan for, say, education planning for the next 5 years versus how we plan for retirement over the next 20 years will be different, correct? And that's where asset allocation comes in. And over and above the asset allocation of equities and bonds, we want to tilt to buy developed and emerging markets. And remember just now I talked about the factors that allow us to capture the higher growth. And then from there, that's how we build a portfolio. The portfolio that we have can be almost as wide as 15,000 stocks all across the world. When you have 15,000 stocks versus 500 stocks, which one gives you lesser risk? 15,000, right? Okay, so just to show you, okay, I just hang on. Let me just move this up. So what if you decide to buy the index or the ETF, 100% equity? So we decide, okay, let's just buy the MSCI All Country World Index. And so all means it's not just US alone, right? It's got US, China, India, Asia, Singapore, Hong Kong, and so on. And from year 1990, if you look at that chart over there, on the left-hand side, right at the bottom, you'll see that the annualized return by putting it into a global all-world country allocation, it's 7.9%, which is okay, fairly decent, quite okay. But you also have seen the ups and downs of the markets. What if we decide to buy in, not just that, but we decide to say we buy and tilt a little bit more to the areas of higher expected returns based on evidence, like what we described, right? We will actually get a 8.8% annualized return, the same time horizon, year 1990, 8.8%. And what if I decide to say, so remember just now that one was about 7.9, right? So by tilting it, we get a higher return. But what if I tilt to get a higher return, but I include bonds to it as well? So I put a fixed income and I tilt to buy more value factors and all the evidence factors, I will get 8.4% annualized return. So it's actually a higher return compared to the MSCI All World Index. And what if I put an additional 20% fixed income? So which means I now have 40% fixed income, 60% equities, but I tilt to buy those areas of higher expected returns. I'll get 7.8% annualized return, which is actually not too far off from just now, right? MSCI World, which is 7.9. Yeah, maybe slight margin difference, but yeah, it's almost as close. That's why I said we are not here to give you the highest returns, but we want you to sleep well at night, but yet at the same time capture that higher outperformance. So far, okay? Okay, this is the interesting part over here. So what we want at the end of the day is to reduce our volatility and increase our expected returns, right? So that over this table, you just look at two particular places. Over here, the black arrow as well as the blue color arrow. Okay, so the first thing is we look at is this thing called MSCI Singapore IMI Index. So this means to say, let's say, because we are all Singaporeans, right? As Singaporeans, typically if you want to buy stocks, will you buy a stock that's in China? Or will you buy a stock that's in Indonesia? Or would you prefer to buy a stock of the same industry in Singapore? Typically, we will buy in Singapore because we understand the local markets. We understand what's happening right here in Singapore. So we'll buy maybe BreadTalk, we'll buy Sakai Sushi, Singtel, your Keppel Corp, and so on and so forth, right? These are the companies that we are familiar with. They're the top 30 companies in Singapore. So if you had bought the Singapore index from 1994 to 2023, you would have a 3.91% annualized return. 3.91%. And your volatility factor, which is this one, annualized standard deviation, is 23%, which means the swings on the market will go up and down. In a normal year, it can go up and down 23%. That's very volatile. Very volatile. If you decide to put into MSCI All Country World, it's 7.1. And your volatility drops to 15.57. Well, isn't that something that makes more sense? Rather than just focusing on one country, you get higher outperformance and you get lower volatility. Makes sense, right? What if we do better than that? That means we say, okay, what if we put in 20% bonds and tilt to the areas of higher expected returns? Remember just now we talked about the evidence. We will then get 8% annualized return. And we will have even lesser standard deviation, which means that it brings down our volatility even further. And we still get higher outperformance. And what if we just add in a 40% bonds and we tilt to the areas of high expected returns? We get, well, 7.25, quite close to the MSCI All World, but your standard deviation, your risk volatility actually reduces significantly. So now if you had a choice, which one will you choose? Will you choose Singapore IMI Index, which is low returns, high volatility? Or would you choose something that's like, well, maybe 7-8% returns, but yet at the same time, much, much lower volatility? So these are things that, again, like I said, we are here to reframe the way we look at returns. We are not just looking at returns, we need to use returns versus risk and how to find that sweet spot. Okay, so question time again. So now that you know all this, I think at the back of everybody's mind is this: when is the best time to invest, right? Because we can talk about all this, we can know the theory and all that, but we are always fearful. We always ask that question, when is the best time to invest? So if you can do me a favor and indulge me again, please, do you buy when markets are up? Is that the best time to buy? Or do you buy when markets are down? Which is the best time to buy? So if you can do me a favor, you go to the chat box and you can help me to fill up and say, well, which is the best time? Is it when markets are up or when markets are down? So just two words, up or down. Oh, thank you so much, KS Chung. Yeah, it's when markets are down, that's the best time to buy. Okay. Anyone else? Anyone else says that when markets are up is the best time to buy? Only one response. Okay, so I asked myself that same question, which I think all of you are asking right now, right? Because markets are probably in a crazy environment. So is it a good time to buy or is it not a good time to buy? So I show you, when markets are down, that means when they define down is that when markets are down and decline more than 10%, they look at the next 1 year, they look at the next 3 years, and they look at the next 5 years. You get somewhere 10 to 9% annualized returns. And this data is captured all the way from 1926 until 2019. They've got almost 100 years of data. So they basically, what they did is they say, okay, certain years you probably look at it and say, well, after a decline, some returns are 11%, some returns are probably 25%, some returns are minus 25%, some returns are minus 45%, and so on and so forth. But when they add all the total, the average is between 11 to 9 point something percent annualized. So that's after a decline of more than 10%. Now, what about when markets are up? Most people will think that when markets are up, then, okay, Jenny says this, down or independent of price. Okay, good. Yeah. So as long as you can hold it, your price will still be okay. That's true. Thank you, Jenny, for responding. Most appreciated. So I think the question is, when markets are up at all-time high, what is the next 1 year, 3 years, and 5 years looking forward? You want to know what it is? So when markets are up, I thought that it will be much lower in terms of returns. But what you see over here is that, again, the same thing, they look at all the way from 1926 to 2019. It is actually roughly between 13 to 9%, which is almost as similar as what you saw earlier. By the way, this is a S&P 500. Why S&P 500 is because they actually wanted to go have data as long backdated as possible. So that gives you the perspective to say that actually over the next 1, 3, 5 years, as long as I'm willing to wait it out, I generally will have a higher outperformance over time, even though the markets are at the highest point. That means they reach this thing called an all-time high. And this is interesting. If you go back to 1970, so you rewind and assume that you went back to those times, would you invest if I told you that there will be multiple crises ahead of you? I mean, if you think about it, from 1970 till 2023, we went through a whole entire myriad of risk and crisis ahead of us. Am I right? Fantastic amount of risk. I mean, 1970s, so many things happened. So if you look at it over here, 1970s, there was oil embargo. You know, oil prices actually quadrupled. S&P 500 was down 43%. Wow, I tell you, those were very, very scary periods. 1980s, US inflation at 13.5%. So we think that right now it feels scary, right? Because inflation is in US at least, it's like between 9 to 10%. But in Singapore, it's probably 4 to 6%. And well, we complain that it's actually high. But in the past, it actually went through worse periods. And then you look at 1990s, Iraq invades Kuwait, Asian financial crisis. We all went through that, right? So, and then in year 2000 onwards, there's dot-com bubble, Y2K, September 11 attacks. And then we had the subprime mortgage crisis. And then in year 2000, we had PIGS, right? The Eurozone debt crisis. Governments actually went bankrupt and had no money, and so on and so forth. Then we had Brexit, we had Brexit, and we had COVID-19 and so on. But if the person has stayed invested all the way and he had money, the $1, or let's say they had $1,000, then that $1,000 would have grown to $80,000 over the entire period. So if I told you that there will be many, many crises ahead, you will probably think, wait, let me hold my horses before I start to invest. But well, if you are able to sit through the experience, then you are able to capture the growth along the way as well. So one of the things we want to reframe is Some people tell me, hey, Greg, can I invest, but I don't want volatility? So usually, those people who invest and want to grow money well, but don't want volatility, they will come into problems down the road. Why? Because number one, there will always be another crisis round the corner. Just that you and I probably can't see it at this point of time. Majority of us can't see. Nobody could see COVID-19 happening back then as well. So, but there will be another crisis around the corner, right? So if you can't accept volatility, your emotions will take over. So if you accept, then you are okay. So there's this person called Morgan Housel. He wrote a very good book. It's called The Psychology of Money. Fantastic read. He says that volatility is the price of admission. That means if you want to get superior long-term returns over the long period of time, your price you pay is volatility. You must be prepared to be going through volatile periods, and you have to accept that volatility is part of that process. But the thing is, you want to make sure that that volatility is something that you can cope with. So rather than go through volatility of you want to get a 13%, 10% return, but if you can't accept that volatility of that 15 to 20% volatility in a normal market, then you better not accept that. And usually that's the reason why we say never put in 100% equity. Make sure you asset allocate and diversify as wide as possible, minimizing your risks. What values at the end of the day, if you think about it, you will want to teach your children, especially when in investment philosophy. The whole world will tell you things like the world's view is overconfidence. It will tell you things like instant gratification. We want things now, today, right now, instant noodles, right? Everything is immediate. There's greed, there's envy, there's anxiety, there's fear. People give up very easily because they try and they say, hey, this doesn't work, and they give up. And there's a sense of ownership. You always think that it's mine, so I want to hold it. But I would like to reframe the perspective for you. What kind of values you want to teach? What I think most of us probably want to teach is probably humility, right? Because we don't know what we don't know. We can never predict what's going to happen. Number two, we should always be patient. If you can practice virtues of patience, you will have a better outcome. You must have contentment. You must have a plan. If you have a plan, then you'll be okay. And you must plan from a perspective of peace and faith. And also there's discipline. Sometimes it's hard, but well, let's struggle through and we be disciplined. It's hard, but let's wait out. Let's sit through the volatility. And then finally, it's about stewardship. Stewardship means that we don't own it. We are only holding it on stewards to be benefiting to the people around us. So we don't own it. God owns it all. So when we can have the right side view, which is basically God's view, you probably can make a lot better decisions that are not due to emotional, but is due to data that drives you. So I come back to this picture again. It's all about shifting your perspective and paradigm. So I hope I did that for you today to help you to look at things from a different angle, like how I started. I said, you want to basically shift the way you see things in your mind. When you are able to shift that mental model in your mind, you make better decisions. Again, a very, very key thing that we want to highlight is it's not the highest returns, but the highest chance of success. And that's with the least amount of risk. That's what we want. But at the end of the day, what we want to do is this. So we will actually help the person to identify where he stands right now. He'll kick in all his details, his income, his expense, his assets, his liabilities, and everything. And then he chart to see where does he run out of money. When you know when you, inverted commas, run out of money, assuming that all your goals you actually put in, you want to provide for kids' education, you want to make sure you buy your car, you want to upgrade your house, and so on and so forth. You can put all your goals you want. But then that would affect you sometime down the road. And how that will affect is through the planning process. And that's where we say it's not the highest returns, but you want to have the highest chance of success. So what's next for you? Well, knowing all this is just knowledge, right? But knowledge without action is meaningless. That means you would have spent time over here, probably the last 45 minutes, 1 hour. You sat through this, you have all this information now, But the thing is, I can tell you, most of us go for courses, right? After we finish the course, we come back, we say, hey, we learned so many things, we picked up so many ideas. But then if you don't implement any of these ideas over the next 72 hours, I can almost assure you that you will not implement and you will have wasted that time after you've gone for the course. So same thing over here. After you sit through this 45 minutes to an hour, you realize that you've got so much information. But what's next? How do you then take action for yourself, for the benefit of yourself? So what's next for you? So for us, what we are willing to do is that we can have a complimentary one-time session to see if we are the right fit for you. Sometimes after meeting a person, we might say, hey, maybe we might not be the right fit. Maybe you have to find another advisor or whichever it is. Or maybe you are not the right fit for us either. So we are not sure. We need to explore and see whether there's a fit. That's the first thing, right? And if there's a fit, the next thing we will do for you is we'll have a complimentary planning. Usually a person will pay somewhere between $3,000 to $5,000 for planning goals, right? For all the financial planning. And this is a total perspective. So you saw at the very beginning, we talked about everything, including tax and so on. But if you feel that is beneficial for you for the next 1 month, we actually provide you complimentary planning. And then that allows us to use that planning to tell you, hey, given whatever goals that you want to achieve, what kind of risk appetite should we take? Should we take higher risk appetite, lower risk appetite? What kind of time horizons are we looking at? So I give you an example. Recently, we worked with this couple. They are probably somewhere in the early 50s. When we looked at their planning in entirety, we looked at it and we said, hey, how come, given whatever you have, you are set to be able to say, I can take care of myself for even 2 generations. So that means even if they live till 95, 100 years old, the next generation take over and continue, there's more than sufficient funds. But I said, hey, but the way you are planning right now, you're taking all kinds of risk, and you're working so hard, then why don't you tell yourself you can be able to say, now I can choose to work and do the work that excites me. I can choose to work because I want to. And I can be able to say, well, I can reduce my risk at the end of the day so that I can sleep better at night. And if we can do these things for you, then wouldn't it make more sense? It's not about the highest returns, but it's about getting you to all your goals that you want. So that's my offer to you to do a complimentary planning. And then, of course, these are the strategies that I talked about using the investment strategies that I mentioned. You can apply that on your own, or we can help them together with you. So from here, I just want to end today's session. And I just want to say, if there's any questions, I'm happy to actually address and take on any questions if there is any. Okay, so looks like there's no questions. Yeah, thank you. Thanks, Ben, and thanks to KS Chung as well. Most appreciated your effort and your time to be over here. I know some of you were putting your kids to rest and all that. Thanks, Benedict. Yeah. So what we'll do is we'll reach out to you, yeah, over the course of the next 1 week or so, and we'll just have a chat and see whether, does it make sense, what you've picked up, and what are some of the areas of questions that you have, and how would you want to be able to use the strategies that you can use using the evidence-based strategies for yourselves. Okay, quick question over here, Benjamin Low. What do you think is the value of a good FA? How do we assess if someone is worth their salt? Actually, that's a fantastic question. Yeah. How do you assess if someone is a valuable FA? So I think the first question that you want to ask yourself is, before you identify whether this FA is good for you, you need to first ask yourself what are you looking for? So a recent conversation I had with this person who was thinking about looking for an advisor. He said, I'm willing to pay an advisor, I'm willing to do this and all that. But I asked him a question. I said, it's not about you wanting to pay for advisor. I think the first question that you need to ask is, what do you want out of your advisor? What is the outcome that you would like to see from the advisor that you are working with and journeying with? A lot of times we just go in from a perspective of a product. But the deeper questions that underline really will be the question of, will I be okay? Will I be okay if good things happens and I live a long life? Will I be okay if things change along the way? Will I be okay if my business turns around and suddenly things turn very sour? Will I be okay if interest rates environment continue to escalate the way it does? Will I be okay if inflation continues the way it does for the next 20 or 30 years? So I go back to the questions of, at the end of the day, is what you want that advisor to do for you. Because not every advisor might be right for you, because they may not be able to address you. And if they can't address the value for you, then maybe they are not the right one for you as well. So these are the questions that you probably want to go to ask yourself. And Benjamin, that's a fantastic question. Thank you for asking that. Um, yeah, thanks so much. So I think the key thing is you need to be able to interview your financial advisor and ask them questions. And also you must see what kind of questions are your advisors asking you. Are they just telling you do A, B, C, D, E? Or are they asking you, why do you want to do A? Why do you want to do B? Why do you want to do C? Because when you are able to dive deeper into the questions, you will answer your questions of not finance, but your questions of life. Okay, so thank you very much. Any other questions that there is? I'll be here for a while more. So for those people that have questions, you want to stay back, I'm happy to address them if there is any as well. Yeah, but for those who need to go, I really thank you and I appreciate your time being here. So yeah, I will let you have a fantastic weekend over on Saturday, Sunday, and maybe even tonight. So may you have a fantastic weekend and we'll connect again. Jenny, thank you very much. Thanks, Greg. No question. Okay, so thank you very much for attending today's session. Most appreciated. So good night, everyone. Bye bye. Okay, so what I'll do is thank you very much for those who are attending, and for those still left over here, I will close the session for tonight. Thank you. Good night. Bye bye.